Spotify Technology SA, ticker SPOT on the NYSE, experienced both strong growth and notable challenges in Q2 2025. Total revenue increased approximately 10% year over year to $4.19 billion, about USD 4.85 billion, falling short of consensus expectations of $4.26 billion. The shortfall was driven in part by adverse currency fluctuations and a 1% drop in recorded ad-supported revenue, though on a constant currency basis, ad revenue grew about 5%, and overall growth measured closer to 15%. Monthly active users rose 11% to approximately 696 million, exceeding company guidance by 7 million users. Premium subscribers grew 12% to 276 million, outperforming forecasts of 273 million. Spotify added roughly 8 million net premium users during Q2, while MAUs increased by 18 million, demonstrating strong engagement and retention growth across global markets, particularly in Latin America and Europe. While these metrics are bright spots, expenses weighed heavily. The company swung to a net loss of $86 million or $42 per share, compared to a net profit of $274 million in the prior year. Operating income fell to $406 million, missing expectations of $480 million due to elevated social charges, nearly $116 million in payroll taxes tied to share-based compensation, higher headcount and professional services costs, and a $104 million drag from currency swings. Gross margin improved by around 227 basis points to 31.5% year over year, reflecting an improved premium and ad mix. Premium gross margin rose to 33.1%, up 171 basis points, as subscriber revenue growth outpaced content costs. Spotify delivered record free cash flow of approximately $700 million in the quarter, lifting trailing 12-month free cash flow to around $2.8 billion. Operating cash flow was strong, and cash and current investments totaled about $8.4 billion by quarter end. Strategically, Spotify continues to diversify audio content. The rollout of audiobooks across Germany, Austria, Switzerland, and Liechtenstein has grown listening hours by roughly 35%. The Voice DJ feature launched in over 60 countries, with user engagement roughly doubling year over year. Video podcast consumption grew nearly 20-fold, with over 350 million users streaming video podcasts globally. Meta markets like audiobooks plus subscriptions for premium users now reach 13 markets. Investors responded positively to this content expansion, even as profit missed elevated expectations. On the outlook, Spotify forecasts Q3 revenue of approximately $420 billion, subscriber base growing to 281 million, and MAUs reaching 710 million. Operating income guidance is $485 million, below consensus of $557 million, while gross margin is expected near 31.1%. The company also announced a $1 billion expansion to its share repurchase program, doubling total capacity to $2 billion, with $1.9 billion available through April 2026. While Buyback signaled long-term capital confidence, guidance pressures and margin weakness tempered investor sentiment. Technically, Spot broke below its 50-day moving average, around $689 during pre-market trading, and retreated towards 681-684 levels, clinging near the lower Bollinger Bands. Trading volumes remain moderate at approximately 1.7 million per day. The 200-day moving average lies near 718-709, creating a resistance hurdle. Support remains around 681-682. RSI readings hovered near oversold levels, 33, while MACD shows bearish momentum. At the same time, longer-term indicators suggest Spot is above its 200-day average, $559-$560, and maintains a bullish bias on a multi-month timeframe. Tip ranks and bar chart technical sentiment summaries range from neutral to minor buy for most oscillators, on balance highlighting mixed technical signals. From a fundamental perspective, Spotify's improved margins and record cash generation reflect structural progress. The business continues to command a premium price-to-sales multiple, often exceeding 6x, though the forward PE multiple contracted sharply after the loss. Free cash flow yield remains attractive, exceeding 2%. The shift toward audiobook, podcast, and voice-based formats support longer-term monetization, while subscriber growth and user engagement remain resilient drivers. However, the reliance on cost control and ad recovery is critical given sensitivity to wage-related charges and FX volatility. In cash flow analysis, Spotify's $700 million free cash flow in Q2 underscores operational cash strength and flexibility to invest in content and AI infrastructure. With trailing 12-month free cash flow near $2.8 billion and cash reserves around $8.4 billion, the company has room to support share buybacks and content licensing without increasing leverage. Capital expenditures remain moderate relative to cash as Spotify continues investing in product development, AI systems, and geographic expansion. Free cash flow margin likely remains in the range of 15 to 20% if operating income recovers. Overall, Spotify posted impressive user and subscription growth, but was undermined by cost escalation and revenue softness. Technical indicators suggest short-term caution as the stock consolidates below key averages, while fundamentals are showing early signs of recovery in margins and cash generation. Investors should watch upcoming earnings execution in content monetization, ad revenue recovery, and cost discipline tied to social charges. The stock remains sensitive to user guidance surprises, regulatory developments, and macroeconomic FX shifts. But the underlying user base and evolving monetization roadmap still offer long-term appeal if execution steadies.